Hi everyone, it's Jack back with another video, and today I'm going to be talking about Realty Income O, ticker symbol O. Known to many as the monthly dividends company, it is a REIT that has a wide and diversified range of real estate in its portfolio, and it currently pays a 4.72% dividend yield, which of course is split up monthly throughout the year. Trading right in the middle of its 52-week range, very low beta on this company, very few big opportunities valuation wise to purchase this company outside of maybe March 2020 and the end of 2022. There's not really been that many opportunities to get this company still valuation wise. It's trades at a high premium. I want to go over this business, talk about why I think it's fantastic, some of the positives, some of the negatives, and then decide whether I think it's a buy, sell or hold going forward. The headlines of why this business is such a sought after dividend play. It's a dividend aristocrat, and it has grew its dividend on average since its public listing in 1994, 4.4% a year, which is extremely impressive. Of those 27 years of being public, 26 of those has had positive earnings per share growth, so it can really back up that dividend, and is in no danger really of decreasing this dividend, or doesn't appear to be. It's had a 14.6% compound annual total shareholder return since 1994, far exceeding the S&P 500, and it does this with a very little beta, a 0.5 beta, much lower than the S&P 500, and that is an average across since its original listing. And it also has an extremely large growth, essentially total addressable market to go into. The estimated global net lease market is $13 trillion. It is absolutely nowhere near this, still mopping up a lot to be mopped up. And it has $95 billion of sourced acquisition opportunities in 2022, and it just continues to push through the pipeline buying at reasonable valuations. The net lease business model is absolutely not exclusive to Realty Income, but they are one of the most famous practitioners of it, and compared to many other REITs that typically own shopping centres and malls, you can see there's a lot of benefits to it. Initial length of lease is typically greater than 10 years compared to less than 10 years for regular shopping and mall REITs. Remaining average term 10 years versus 5 to 7. Responsibility for property expenses, which is a big one in my opinion, fall on the client rather than the landlord, and this gives gross margins of greater than 98% on average compared to just 75% for more typical REITs. Low volatility of rental revenue, maintenance capital expenditures are low, and they have very little reliance on anchor tenants, and they have many target markets and high external acquisition opportunities. This company doesn't rely on anchor tenants because it has a really strong client diversification. No client has more than 4% of annualized contractual rent. That is the largest Dollar General at 4%. You can see Walgreens 3.6, 7-Eleven 3.5, Dollar Tree 3.3, wide variety of businesses. The top 20 clients, the lowest one there is over 1% of the business. Still, that doesn't even take up that much of the business. Grocery stores account for 10% of annualized contractual rent, but there is still really strong industry diversification here. Convenience stores at 8.6, dollar stores 7.4, restaurants, drugstores, home improvement stores. A lot of these are relatively big box retailers that I would consider to be the main attraction of a retail park rather than being in a mall per se. Geographic diversification isn't perfect by any means. 10.4% in Texas, 5.8% in California, but 9.5% in the UK. They are gaining an increasing presence internationally. They just entered Italy for the first time, and they have a couple more around Europe. You can see Tesco and B&Q for its UK presence, as well as Sainsbury's. So they're definitely diversifying, but this is a predominantly US-based business with a lot of exposure to US commercial properties. Part of the reason this business's base is so strong and its results are so strong is because of it's just superior stability from an operator's perspective. It typically has portfolio occupancy around 98%, which is just exceptionally strong. Lowest year end it's ever been is 96.6%. Compare that to the S&P 500 historical median, 94.5%. Lowest year end for S&P 500 average REIT, 92%. Just nowhere near Realty Income. It's just superior performance. Has an average credit rating of A3, which is really strong compared to the average S&P 500 REIT, which are not really anywhere near that on an average basis. No years of negative growth. 4.4% dividend compound annual growth rate compared to the average S&P 500 REIT, which is at 2.8. Just really strong. I think this graph illustrates really well the power of stable earnings and low dividend volatility. In terms of annual total shareholder return among S&P 500 companies, Realty Income's downside volatility since 1994 is just 3.4%. That is the 8th lowest of all S&P 500 constituents. That puts it in the same realm as Johnson & Johnson, Church & Dwight, AutoZone, companies that very rarely experience much volatility, are around the same sort of ranges. In the 52-week range is very rarely a large spread and provides consistent shareholder returns over that period. This year, it's been between $55 and $75. It's currently $64. That is really not a very large spread considering the economic turbulence that's going on at the minute. Clearly, Realty Income prioritises shareholder returns and the stability of those shareholder returns. One might expect a company like this to be relatively low growth, take very few risks, and be kind of just in its niche and not really doing anything else. That couldn't be further from the truth. Realty Income's, while doing it in a risk-averse manner, they're increasing their source volume, particularly internationally, at a spectacular rate, while risk is low in their opinion and while they can get good prices. In 2022, they had $95 billion of source volume, which is around 25% of that was international. In 2021, around a third of that was international growth of $84 billion. International opportunities added greater than 30% to Realty Income's combined sourcing volume since 2019. I think you could make a fair argument that this is increasing the risk of this business internationally, not its traditional market. You can see between 2010 and 2018, essentially no sourced volume from international sources, whereas now the acquisition volume is increased at quite a rate from 2020. It's tripled since 2020 to 2021, and from 2021 to 2022, it's up nearly 50%. So they're definitely being opportunistic with what they believe are low prices. I think a really good example that happened this year of Realty Income maybe increasing its risk profile but doing it in a responsible way was buying Encore Boston Harbor Resort and Casino from Wynn Resorts for about $1.7 billion in a sale and lease back. This is its first acquisition into the gaming industry, but seems to me a relatively high quality portfolio acquisition and just a generally safe-ish play. And I like that they're continuing to increase the diversity, and I like that they're buying into this space. They also boosted the European portfolio significantly in 2022, and as I mentioned, entered Italy for the first time in addition to the UK. A company with this sort of track record and this sort of stability is always going to trade at a premium to the S&P 500 in my opinion. It's just never, you're not going to get that many sellers and there's a continual flow of net buyers. I find REITs difficult to value on a price to FFO basis. I just don't think it's a very good metric. I'd prefer just looking at price of cash flow and price to book value. Price to cash flow, the 5-year average for this business is around 19, call it 20. The current is around 15 and a half. That's a decent valuation in my opinion, by no means cheap. Price to book value on a 5-year average is around 2.21. It's very high in 2021, around 3.17. Right now, 1.49. Not screamingly cheap by any means, but cheap versus 5-year valuation for sure. This business is not going to blow the doors off with growth by any means, so the PEG ratio looks pretty high in my opinion. The earnings yield is very low. However, it's a stable business and it has continually really strong earnings and really strong shareholder returns. This is not the type of business that is going to appeal to value investors. This is the type of business that is going to appeal to income investors, to people who are dollar cost averaging over the long term and are benefiting from the stability of this company. Never really trades at huge discounts to the S&P 500. You can see in March 2020, which I would consider an exceptional event, did have a huge dip, but over the long term it typically outperforms the market. The chart is up and to the right, and it has never really been any great buying opportunities to get the company at dirt cheap valuations. You see even the 52-week range, 55 to 75, that is relatively tight in my opinion, and that is only because there's been the interest rate crisis, I would call it, that the stock dropped that low. This is an exceptionally well-performing business and one that I'm pretty comfortable buying right now. And I'm going to dollar cost average over time. I'll be pretty comfortable holding it. It's the type of company that you can let you sleep at night, pays a nice dividend around 5 or just under 5% right now. I'll be pretty happy holding this company due to its stability. Of course, I'm not a financial advisor. You should not take this as financial advice. If you do want financial advice, go and seek out a registered financial advisor or do your own research and due diligence. That being said, like and subscribe if you enjoyed the video. Let me know in the comments down below what you think about Realty Income, what you think about getting monthly dividends, or whether you prefer share buybacks, or whether you prefer REITs or other companies. Let me know. Like and subscribe. I'll see you again next time.